Hello everybody, this is AK. I'm back. So my attempt to strengthen my T-bill ladder in today's auction failed. It's a bit surprising. I mean, non-competitive bids, only 83%, approximately 83% of non-competitive applications were allotted. Seems to me like it's a rather low percentage. So my attempts to strengthen my T-bill ladder, like I say, in this auction has failed. When I saw quite a bit of money being refunded to me just now when I went to check my bank account, I was doing a fast transfer to a friend to pay him for something he bought on my behalf. I knew that this T-bill auction must have been very popular. Well, it isn't a tragedy. Right? It isn't tragic. Right? I'll just put the money to the next T-bill auction, the next 6 months T-bill auction. I suppose this shows that the idea of T-bill laddering has gained traction, and it has become more mainstream now. More people are interested in T-bills, and possibly you having a T-bill ladder to generate some passive income. And for investors, the idea of using a T-bill ladder to store their money, their war chest, while waiting for Mr. Market to go into a depression, doesn't seem like a bad idea, right? The cutoff yield for this auction was 3.74% per annum, still relatively attractive compared to what we can get from fixed deposits for 6 months fixed deposits, and it's risk-free, right? There's no price risk, and of course, some people have asked me why don't put the money in some funds. For example, there's one that's by a stockbroker, which makes a sound like what a farm animal would make. All right, and that is what I think 5% per annum. Yeah, but I remind myself that they are not a bank, right? So it's not insured under SDIC, and of course, we have to ask what's the credit rating, right? Because T-bills, I mean, 3.74% per annum is AAA rated, is Singapore government backing it, right? And if you put your money in a fund with a stockbroker, then you have to ask what's the credit rating, whether that little bit of extra interest is worth the risk, right? I rather not take the risk, I mean, it could well be quite safe. I don't know, but it's a very personal thing, and it's just like I told some viewers before that some people are saying, oh, we should be buying bond funds now because when interest rates come down, bond funds prices will go up, right? So they are thinking of benefiting from some upward movement in bond prices, but we have to be very careful as to which bond funds we put our money in, because if you are looking at bond funds which put money in AAA rated bonds, like those issued by the Singapore government, the yield really isn't the yields really aren't that high. They are quite possibly even lower than what we can get for Singapore savings bonds. So it really depends on our objectives, what we're after, right? And if a bond fund is able to offer us something like 6% per annum in yields, you have to look at what kind of bonds that bond fund is actually holding. I'm willing to bet that there's probably some junk bonds in the mix, Otherwise, the yields won't be that high, right? So just have to do our own due diligence. But I'm quite happy stashing more money away in T-bills while waiting for Mr. Market to go into a depression, which is a matter of when, right? And of course, I'm still staying invested. My investment portfolio, I mean, in equities, that's not changing because I'm already vested, right? And if you ask me whether I'll buy some more at today's prices, well, it depends. It depends, right? So it depends on the stock, right? So like the banks, they say why buy T-bills, why don't buy DBS, OCBC, and UOB, which are offering upwards of 5% per annum. Well, like I say, you know, those are not risk-free, as in there's price risk, right? You know, you could buy and you think that you are quite happy with the dividend yields, but if stock prices should plunge for whatever reason, can we stomach that plunge? You know, as long as we can, I suppose that's quite okay, right? That means we have an appetite for risk, and it's not money that we need in the near term. I think that's fine, right? But for me, I'm already substantially invested, like I said, so I don't see any need to add. I would rather add if there's a pullback in price, especially if there's a significant pullback in price. That's when I'll be adding much more, right? So entirely up to the individual. Now, if AK can talk to himself, so can you. Bye-bye.